You bought more Apple.
Yeah.
In which you've made the case repeatedly, yep, I'm in Apple, but I'm underweight it. I'm underweight Apple. But now you bought more. Now you may still be underweight.
Yeah.
But why'd you buy more?
I am still underweight, and this is 7% of my benchmark, right? It's 7% of the S&P 500. So I'm never going to be 7% of anything in my portfolio when I only own 30 stocks. So to me, that's just prudent. But I do think that, look, I was bracing for Apple to be horrific. I was bracing for guidance to be terrible. And it actually wasn't.
Well, they guided down a bit.
Yes, but we were expecting that, and I was expecting even worse than what they guided down to. In fact, I thought they guided down 10% in revenues,
it's
which
like
was about in line.
$3 billion.
But services, they didn't guide down 11%, and that's kind of an exciting part of the story, which we talk about all the time. But overall, the quarter, with as many headwinds as this company has, I mean, you had earnings growth of 12%, EBITDA growth of 16%. You had free cash flow growing 26%. They have $173 billion in cash. They have been buying back stock, and they're going to announce another buyback next quarter, which is what they traditionally do. And I suspect it's going to be another $90 billion. That's 3% of the shares outstanding. So then I looked at guidance. So then I looked at where numbers came down, and they didn't come down by much, Scott. And the stock is down 6.5% from its highs. So no, it's not cheap by any means, but I just didn't want to be so underweight because I do still believe in the long-term story, especially once they fix China and iPhones in China, which is 20% of their iPhone sales, and iPhone sales are 50% of the total revenue. So it's material, but they're going to get that fixed. And again, service is going to continue to grow. And then, Vision Pro and all these other things possibly can be nice tailwinds later on. I'm not really counting that much on that, though.
So it's the timing's perfect because CNBC did a poll with the Generation Lab Youth and Money. Apple's the favorite stock investment for young people, according to that poll. Names that you'll find on the list, Amazon's big, Tesla, Microsoft, Google, but Apple stands out from the crowd. There you go. Just to show you here. You want to comment on this?
Look, I like the purchase. I'm being a little bit more coy. I'm waiting to see if I can get it at a little bit better price. I'm underweight the name. We all know that.
You had your chances passed when there was a 1.6, not a 1.8 on that.
When was it 1.6?
It was 167, 169, not that long ago. Apple?
Was I on vacation?
No.
Okay.
No. There was a time, I don't know, we could pull the chart up.
You're talking about when that downgrade came up and it rocketed up. That was like October.
No, but the chart was ugly.
All right. So, look.
And that wasn't that long ago.
Yeah, but all right, I don't think it's been down in 160 land this year. If I'm wrong, I'm wrong.
No, I didn't say this year, but not that long ago.
Look, I don't have a problem with these valuations, whatever it is, 30 times forward earnings on Apple, 35 times forward on NVIDIA. These are not like what you saw in 1999 where Cisco was at 100 times, Qualcomm was at 200 times. But I go back to where I was, and I do have a little cash. I'm looking elsewhere. I'm looking in industrials. I'm looking in healthcare, where I think you can find some stocks that are still, ready to bounce out of the malaise of last year. I'm just not that compelled to add to these names here.
So I agree with you. I'm overweight in industrials and financials. And even materials and energy. So I'm there on the value spectrum without a question. And I do think eventually we will see a broadening out. I have been so underweight technology. That's why I'm going to nibble into Apple. And if it does fall back down into 160, which is where it was in October, then.
In October, right.
Maybe I'll buy more.
All right. Now, I almost fell on my chair when I saw this next move because this is just, with the real Stephanie Link, please stand up. You bought Snowflake?
Oh, it's a small position. It's like 50 basis points. It's not in my it's not in my benchmark, but I do think cloud data warehousing is a really big deal. It's a total addressable market of $90 billion. These guys are a leader. They have size, scale. They have a value proposition. They have a whole new product cycle story that's about to come out.
They also have a pretty healthy valuation, no?
They have a healthy valuation, but you're looking at revenues on a CAGR basis between now and the end of the decade, potentially at 30%. I don't have any stock in my positioning in any industrial, in any energy company, in any financial that is going to grow compound annual growth rate at 30%. And so to me, this stock actually hasn't done all that much in the past year. It's up 33%, had a decent year last year. However, if I believe, and I do, in this concept, in this particular market and their positioning in this market, then I want to have I want to have a small position. It reminds me very much of like Fortinet. I could never really justify the valuation of Fortinet, but the total addressable market is a place, and the concept and their market share is something that I want to be part of. So I will right size it, which I'm right sizing Snowflake. But
I hear you, but you're making a case, I think, more broadly as to why people have been buying growth over value, and a willingness to pay up for the amazing growth prospects that you yourself just laid out. Right? That's the whole point.
Yeah, no, I agree with you on that. And that worked last year. But I do think you're going to see a broadening, Scott. I do think the economy is going to stay strong. It may not stay strong like 4%, which is where we're growing right now. But even if it's 2%, that's good enough for mid-single-digit earnings. I think margins are going to be the story, to Shannon's point earlier. And I think earnings are going to be good across the board within the market. And so this year, very much like during COVID, I was trying to do that barbell, a little bit of growth, a little bit of value. I kind of want to do that this year, too, because the opportunities are just too great for the long term in some of the total addressable markets in growth.
I got another move I want to get to in this first segment that we do, Josh, is from you. You sold PayPal. So I think you made it clear in the last couple of weeks you weren't really happy with what happened on that, I can't remember what investor day or whatever it was, where the stock was down a lot as the CEO was announcing these new initiatives. Now you've sold out of it completely. Why?
I don't trust these guys. And I also think that the market came into this year hot as a pistol, and I'm just looking at breadth start to turn negative. I'm not sure. Jimmy was talking about things broadening out. It's actually the opposite. We're at 62% of the S&P names are above their 50-day. It was 90% coming into the start of the year. 90 is probably too hot. 60 could very quickly go to 40. I'm looking at the average RSI in the S&P 500 at 53, right at the historic average. So not, anything to be alarmed about, but certainly has room to fall from there as well. So I just think overall, it's probably not the best environment to have your 20th favorite stock going into earnings. And if I'm wrong and they have a great report or they get people excited, I'm willing to miss out. I'm not willing to look at the stock, back in the mid 50s where I first bought in, or worse. And honestly, I think it's going to be a couple of quarters after the fiasco 2 weeks ago before anybody feels really good about the direction here and the new tech initiatives. So I know they're trying hard, no disrespect. It's just not a game I feel like playing today.